Good morning, friends. We are starting our session. Today is 23rd January, and let us start by remembering our national hero, Netaji Subhash Chandra Bose. And today happens to be his birthday ceremony. His contribution in the our independence movement uh, should be properly recognized. Now, coming to our today's session, let me welcome Mr. Ajay Bodke, who is an independent financial analyzer, and he has come to our venue, that is Lokmanya Seva Sangha, earlier also, and we were all thrilled by the manner in which he had spoken to us and made the presentation. Therefore, he is known to our audience, and still, as a matter of our courtesy and gratitude to the leader, I would just like to highlight that Ajay is a very studious person. That's most important so far as our investment climate is concerned. He is an extremely good speaker, makes his presentation, and by way of qualifications, he has got rich qualifications and rich experience. He is an engineer, MBA. He has worked here in India. He has worked abroad. And more important is to listen to him with intent rather than describing him. So over to Ajay, and the next 45 to 50 minutes are yours, and thereafter you will, I'm sure you will be able to answer any questions which the participants would pose to you. Over to Ajay.
Uh, Thank you, sir. Uh, I would like to thank all the office bearers of the Institute for allowing me this opportunity to come and share my views and have this interactive session. I think, as Dhere sir has mentioned, it's been a privilege. This is, I believe, the third time that I've been coming, that I have had the opportunity of coming to the Institute and interacting with all the esteemed members. Once had was there for the annual fair in 2019, and prior to that, I think twice. I think I had come. I think on the ground floor of the institute, we had a very nice interactive session. Uh, I think, as sir has said, that over the next 40-45 minutes, I will make a few points. But at the same time, I would request the members, in case they would like to jump in and sort of, have, and if there's any query, I'll be more than happy sort of, to engage with them. To start with, I think it reminds me of that memorable quote of Charles Dickens in his classic, The Tale of Two Cities. It was the best of times, it was the worst of times. He says, it was the age of wisdom, it was the age of foolishness, it was the epoch of belief, it was the epoch of incredulity, it was the season of light, it was the season of darkness, and it was the spring of hope, it was the winter of despair. I think since March 2020, or rather December 19, when this pandemic has swept the entire globe, one can easily identify oneself with both the sides of the spear that I just mentioned. As an investor in equity markets, I think it certainly is the spring of hope. But for tens of millions of people who have lost their loved ones and the healthcare workers who have dedicated themselves in risking their own lives, their families, and helping all of us out of this once in a century pandemic, it certainly was a winter of discontent. But then I think they have uh, risen up to the occasion to help the mankind. Now, as an equity investor, sometime in June, I wrote an article for the Economic Times and I summed up the investment climate in equities by using three acronyms. And this is especially true for those who have been new investors, and we have seen plenty of those, millions of those all over the world, including India. And those three acronyms sum up, in my opinion, the feeling among many investors. FOMO, fear of missing out. PY, buy the dip, PTD. And thirdly, TINA, there is no alternative. I think the confluence of circumstances created because of torrent of liquidity created by the global central banks, led by Fed and followed by others, including our own central bank, plus an equally large dollops created by the various fiscal authorities to help pump prime the economy and to stave off a great recession, essentially has been responsible for the climate that I just described insofar as investment in equities is concerned. Just to give one example, when the crisis started in March 20, the size of the Fed's balance sheet was roughly $4 trillion. And if you take a guess that just within 2 years, it's ballooned to roughly a shade below $9 trillion. So effectively, in I would say last 2 years, I think less than 2 years, I think we are seeing the Fed balance sheet, the most powerful central bank's balance sheet, more than doubling. And there was a reason for this extraordinary monetary accommodation by the global central banks. Whenever the money markets seize, which is what happened just after March 2020, when the confidence among the various participants in money markets, various banks, was at its low, and they were unwilling to lend to each other even overnight money. The financial stability of the global financial system was at stake. And that's when the members of the Fed, in consultation with the Treasury in America, decided that they needed to use the tools of extraordinary monetary accommodation, because simply bringing down the interest rates to near zero would not suffice, but they would need to actively participate and start buying not only government debt, as they did during the great financial crisis of post-Lehman, but even they ventured into buying corporate debt, and not only investment grade corporate debt, but even, I think, below investment grade corporate debt. And then they were followed, I think, by Bank of England, ECB, and other central banks in emerging markets. So it was a response to ensure that the global financial system doesn't collapse and the stability remains intact. They were also supplemented, as I mentioned, by various fiscal authorities led by the US government in terms of crafting packages which ensured that direct income support reached the most vulnerable sections of society, and the buying power that had gotten extremely sort of shaky because of overnight loss of 13 million jobs in America. I think to a large extent that that blow they tried to soften through infusion of trillions of dollars of fiscal packages. Not only was direct income support provided to citizenry, but also sector-specific packages to ensure that industries which would have folded up, like airlines, hospitality, tourism in particular, entertainment, I think were given dollops of support so that they could survive, I think, these trying times. All of us also saw the extraordinary effort put by the scientific community. And finally, I think we had the the vaccines, the mRNA vaccines to start with, but also the efforts by various emerging markets like China and India, I think in terms of, and Russia, in terms of ensuring that the right vaccines, I think, are produced and then are distributed to a wide range of citizens. Today, I think we are a long way off from those dark days. The headline indices in India have more than doubled since March 20, and the small cap indices, in fact, would be up more than 2.5 to 3 times from the lows that we saw in the wake of March 20 panic. Now, we are now at a cusp where there is a belief among global central banks that they need to pull back from the extraordinary monetary accommodation. And we already have seen the US Fed, the most powerful central bank, indicating that the rising inflationary pressures, which they believed for a long time, for the last 12 months, if you pass through their monthly statements, the word transitory was used ad nauseum. And the inflation did not turn out to be as transitory as the US Fed expected it, or made us believe. So now I think with massive blowback on the political front that the Democratic Party is bearing, and there are midterm polls in November in America where 1/3 of the seats of the US Congress and 1/3 of the seats of the US Senate will be up for elections. And the Republicans clearly sort of, are using this as a strong electioneering point. The inability of the administration in ensuring that the inflationary pressures are kept well anchored and inflation starts moving back to the 2% trajectory, which is the mandate sort of, that the Fed has set for itself, in and around 2%. But right now we are running at 7%. So hence, I think the belief is that the US Fed will raise rates at least 3, if not 4 times, 25 basis points each. There could be a shock and awe in the meeting in February, where a section of the market believes that they might increase the rates by 50 basis points just to drive home the point that we are serious about taming the inflationary demons. And in addition to that, the real fear that is enveloping the market is, and you'll hear this word more often now, QT. You had heard the word quantitative easing. It basically means printing money on the part of the central banks by buying bonds and infusing liquidity. Now it's time for a reverse course. QT, quantitative tightening. So sometime towards the end of the current calendar year, this bloated balance sheet of 8.7 trillion, at least some baby steps need to be taken by the Fed in rolling out a timeline over which they will start unwinding this massive infusion of liquidity that has happened over the last 2 years. And that obviously will lead to strengthening of yields. Then you'll have to telescope this and choreograph this very, very carefully. They don't, because they don't want the hardening of the yield to happen, because the debt to GDP ratios in all economies have moved up very sharply over the last 10 to 15 years. And hence the central bank and hence these governments also will be keeping a very close eye on hardening yields. So this is, I think, something that the markets will have to contend with. And what I told you about Fed is applicable for almost all central banks. In fact, the Bank of England has already raised the rates once. Coming back to India, I think the RBI also has started gingerly withdrawing the extraordinary monetary accommodation through infusion of liquidity in the debt markets. And the expectation is that if not in in the next meeting, possibly a meeting later, they'll have to start raising rates, because the parliament mandated MPC, the mandate that Monetary Policy Committee has is to anchor the inflation expectations around 4%, with a band of plus or minus 2% on either side. Now they have taken that literally, and the inflation has been running, I think, at around the upper end of that band. Mr. Limaye's, I think, yeah, sorry. So there is an echo from Mr. Limaye's, Shrikant Limaye. Yeah. So, sorry. So coming back to the mandate sort of that the RBI has, I think very soon, in my belief, that they'll have to start moving away from that upper end of the mandate towards the midpoint, that is 4%. They might take, I would say, a few quarters to reach there. But I think that's the trajectory that I see, in addition to the withdrawal of monetary accommodation. Now, coming to the economy, uh, let's look at the various drivers of economy. The most important driver for Indian economy is domestic consumption, which contributes roughly, say, 70% of total GDP. And a whole host of industries, I think, are dependent on how the aggregate demand pans out in the domestic consumption. And the signs that are emerging out there are not wholly positive. Why do I say it? Although sort of, if you look at the two halves, the urban consumption and rural consumption, and the commentary that's coming from companies which cater to the two sectors, one clearly sees that massive jump in global commodity prices, both agri-commodities. In fact, you'll be surprised to know that the UN's World Food Index is at its all-time high today. I think if you remember the last time it had reached these levels, there was massive discontent on the streets of various Arab countries in North Africa. And today, I think, we are already reached that point in terms of the World Food Index. So the global agri-commodity prices are on a boil. We are seeing crude on the cusp of breaching the dreaded three-figure mark. Many global biggies like Goldman Sachs and Morgan have predicted by the third quarter of next calendar year, they see Brent breaching $100. We also have seen many industrial commodities, I think, sort of, moving up very sharply in last 1 year. So the entire commodity complex, agri and industrial, has seen a sharp rise. Now, one of the reasons for this rise is not only this infusion of large liquidity, which is leading to ballooning aggregate demand in various economies, but also perversely, I would say, the necessity for all of us to tackle generational issues like climate change, green energy, I think has led to, I would say, stigmatization from the investment community by leading to derating of companies which are in so-called sin sectors. So this large money going into ESG funds and money moving out of companies which are in utilities that use coal, oil refineries, oil exploration companies, and I'm not considering the tobacco and cigarettes. Let's keep that aside. But at least the complex that I just described in terms of the utilities using fossil fuels and the oil and gas sort of, entire chain from upstream to downstream, has made companies worry of committing large amounts in brownfield expansions, leave aside greenfield expansions. Now, what this has, and this whole idea that we are moving to electric vehicles a year from now, 10 years from now, has basically led to less of investments. And as a result, the demand has moved up, the supply side has not kept pace, and markets clearly see that if you start investing in any new greenfield project in oil and gas exploration, it takes years for the output to basically sort of come on stream for commercial production, and this after you're able to strike it right after many attempts in terms of exploration. Now this is essentially in my belief led to a situation where one will have to uh, bear the rise in prices of these hard commodities for some time to come, and this sort of is feeding into margin pressures for many companies. So today, if you look at the results, 140 companies roughly have come out with, large companies have come out with results for the current quarter. And although on a YOY basis, the top line seems reasonable, led mainly not by volume growth, but by increase in prices uh, by various companies. The real problem has started appearing in at the margins, be it at the EBITDA level or at the net profit level. The gross margins are clearly under pressure. Companies have made an attempt to pass on partially the cost push inflation that is hitting them. However, sector after sector, the management commentary is indicating that the margin pressure is there, it's real, and it will take a few quarters for the companies to pass on the entire cost push inflation that they have to bear. They're also hoping for operating leverage to come into play and sort of, the volume growth also to pick up, which currently is subdued. It is more so in case of rural companies. If you look at the commentary of levers, some of the two-wheeler companies, some of the ceramic companies, I think the margin pressures are clearly evident, and the outlook, I think, remains, I would say, moderately positive. I think over the next few quarters, we'll have to wait and see how the Rabi crop output, the moisture levels are good. Although the monsoons were erratic last time around, I think they were good, I would say. And hence, reservoir levels being good, moisture levels being good, expectation is that the Rabi output also should be good and should act as a tailwind for aggregate demand in the rural sector. And the non-agri part of incomes, which constitute roughly around 50 to 55% on the rural side, also sort of, I think is doing reasonably well. On the urban side, I think the demand trends are better than the rural area. Here again, sort of, a K-shaped recovery is clearly evident. I think what I mean by K-shaped recovery is that a small sliver of rich and upper middle class population has done exceedingly well in terms of wealth generation and in terms of income levels. Sectors like IT, ITES, I would say healthcare, some parts of retail, the non-contact industries, I think, have done extremely well in the urban areas, and that is fueling aggregate demand. If you look at investments, the second part, which constitutes roughly around 15-20% of total GDP, there is a school of thought that India is on the cusp of a multi-year investment boom. What are the ground realities? The ground realities are mixed. And I would take you back in history. The reasonable success of the IBC regime, the bankruptcy regime, insolvency and bankruptcy regime, in a way acted as a headwind for revival of capex in few sectors. What do I mean by that? I think I've elaborated this point in previously also in few forums. Let's look at steel sector. Now, there was a lot of malallocation of capital that had happened during the previous regime, especially let's take steel sector, Bhushan Power, Bhushan Steel, even other companies like SR Steel were on the verge of bankruptcy, Bharat Ispat, and many others. A successful IBC regime ensured that deep-pocketed, serious global and domestic players were able to buy out these doddering uh, large investments. And as a result, say a Tata or ArcelorMittal or a JSW Steel that would have otherwise gone in for greenfield expansion, they ended up buying Bhushan Power, Bhushan Steel, Bhushan Power, SR Steel, which were operating during the last few years under the previous managements at 20%, 15% utilization levels because they were not able to get working capital support from the banks. Understandably so, because the promoters did not elicit that confidence, having defaulted, and some of them being accused of green plating the project costs. But when these AAA rated promoters took over these assets, the cost of funds went down for their operations. They were able to ensure that the costs were aligned with their main operations through joint procurement of raw materials. They were able to utilize their distribution network in selling the goods being produced by these units that they bought over. So the costs got aligned, the margins went up, and the country as a whole gained because these assets otherwise would have uh, become NPLs, and all of us as taxpayers would have suffered. They would have had to be liquidated. So, but what happened because of this is that for 2 or 3 years, the capex cycle got pushed ahead because now I think the first task that the Tatas had is to ensure that the Bhushan Steel's utilization levels went up from 10-15% to say around 80-90% in line with their other operations. And once they've achieved that, and once they are confident that the demand continues to grow at a robust clip, then they'll think of a newer project. A similar dynamic played out also in cement sector, where Jayaprakash and many other uh, below scale cement plants were bought over by Ultratech and many other large players, and a consolidation happened. So I think in many capital intensive sectors, we have seen this consolidation happening, which is good from the long-term, medium and long-term economic point of view. From proper allocation of capital is concerned, from that perspective. And now I think we are at a stage where we have seen the demand growing over the last few years, and we are at utilization levels where the managements are now thinking of going in for either brownfield expansion, and wherever it's not possible, going for greenfield expansion. So over the next 3 years, I would tend to agree with that section of market that believes that we are on the cusp of the start, or we are the start of a new investment cycle, which we hadn't seen for many years now in India. Uh, in addition to that, the PLI scheme promoted by the government, where roughly 1.6 lakh crores worth of benefits have been doled out, uh, linked to certain output linked parameters in sectors like mobiles, bulk drugs, uh, consumer durables, and many others. I think hopefully over the next 5 to 10 years, also in case of consumer goods, staples also, uh, ready-to-eat foods, etc. Hindustan Lever has just announced a couple of days back. So I think with the orientation of ensuring that the import dependency reduces, the country becomes more self-sufficient, and also with an intent to provide a tailwind for exports, I think the PLI scheme also will contribute to the capex cycle, in my opinion, over the medium term. The third leg of aggregate demand is net exports. Now, there again, as I said, the PLI scheme will play its part. But in the interim, I think the service exports, especially the IT and ITES, are roaring. I think we are in the midst of a multi-year boom insofar as provision of IT services by Indian vendors to global biggies are concerned. And embrace of newer technologies like IoT, artificial intelligence. Uh, I think if you look at the commentary from many of the leading IT vendors, they clearly believe that not only would demand continue to remain strong, but they would have levers over time of passing on the increase in costs that they are seeing. Today, I think we are seeing the margins getting squeezed because of increase in subcontracting costs, massive attrition. I think I hadn't seen attrition levels of mid-20s in companies like Infosys. TCS is lower, I think, and many others. So they are trying to address that by uh, using various levers like more offshoring of business, uh, ensuring the pyramid uh, structure is addressed by recruiting more freshers, creating the bench strength, and operating leverage because of large increase in top line. But they'll still have to navigate, in my opinion, margin pressures for a quarter or two. And the more shift in business that they achieve towards higher value added digitalization and the newer technologies, I think the lesser pressure they'll face on their margins. Uh, on the pharmaceutical side, I think one clearly is seeing continuance of uh, pricing pressure in the biggest market that the Indian vendors have, which is America, because of extraordinary consolidation of the buyers in America. Although it has eased when one compares over last 24 months or 36 months, I think the commentary indicates that the pressure still is there. So the domestic focused companies have done better during the pandemic. Uh, but here again, like chemical companies, sharp rise in input costs of APIs, of bulk drugs, of in case of chemical companies, again, the basic chemicals that are imported from China because of paucity of containers, because of logistical nightmare that many of these companies have to navigate, be on the shipping side, or in case of America, one is seeing paucity of, and in Britain one saw that, I think paucity of trained drivers. So logistic costs have gone up. So I think one clearly is seeing the pressure even in this part of the market, be it chemicals, be it bulk drugs, pharmaceuticals. Uh, so overall, I think, one will need to keep a very close watch, as I said, the uh, on the margins for many of these companies, with commodity prices expected to remain elevated for a few quarters. Uh, on the autos, I think one has read a lot about the paucity of semiconductors uh, constraining many of the auto companies from producing to the fullest extent, and a large backup of orders in case of passenger vehicle companies globally and in India. The reasons are simple. When the pandemic hit the globe, many of these semiconductor manufacturers could not foresee demand coming back rapidly and so soon because of the extraordinary monetary accommodation provided by the fiscal and monetary authorities. And hence they shuttered their operations to a large extent. And then when the demand came back, I think restarting the operations takes time. And there they started prioritizing the high margin customers. And that essentially is the mobile telephony, network equipment, laptops, other industries that they preferred. And then came consumer durables, and lastly was automobile sector. So hence, because that's where the margins are the lowest for them. And hence the auto companies have been the worst sufferers of this paucity of semiconductors. Expectation is that it will take a good 6 to 9 months from today for normalcy to return. And hence one needs to brace oneself for production constraints being part of the commentary that one should hear from many auto companies. And the shift to EV is a shift which one can't deny, but I think it's a multi-decade shift where a lot of subsidies, fiscal subsidies, need to be provided by various governments. If you were to split the auto sector, then the weakest point is the two-wheeler sector, where not only are the embrace of EVs is the fastest, it is the fastest in case of three-wheelers, followed by two-wheelers, followed by, I would say, the passenger vehicles, and then last would be the commercial vehicles. The heavier the vehicle, the slower is the embrace. Understandably, because of the battery, the power of the battery, the mileage, etc., the costs involved are daunting for heavier vehicles. So I think the part of the market that looks better placed, in my opinion, is so coming back to two-wheelers. I think the incumbents are facing challenges from the EV players, and as I said, a large part of their demand comes from the rural sector, which clearly is seeing a slowdown. This K-shaped recovery, if there's one sector other than FMCG where it is evident, it is two-wheelers, where the higher priced bikes are not impacted as badly as the lower priced bikes. Tractors had seen robust growth over the last 2 years, and hence the base effect itself is acting as a headwind for tractor demand or the volume growth in tractors. Commercial vehicles, as the economic activity is picking up, I think parts of commercial vehicle product range is expected to do well. Construction equipment, mining, long haul transportation should do well. Passenger vehicles, as I said, robust demand, but there are constraints the companies have because of the shortage of semiconductors. Autos is an important sector because the linkages that auto has with other manufacturing sectors, I think cannot be. I mean, it needs to be sort of cannot be downplayed. So I've covered, I think, banking, I think, which is 35% of Nifty. I think, how could I forget banking? Corporate trade cycle hasn't yet picked up. Tepid, extremely anemic growth continues on the corporate side. On the retail side, I think the trends are better. Mortgages is doing very well. And some of the other high margin products for them on the retail side, be it personal loans, credit cards, uh, also are doing reasonably well. Uh, the positives in case of BFSI, banking and NBFCs in particular, is the pain that they've endured after the AQR was announced by Raghuram Rajan and the banks were forced to start acknowledging and recognizing the lakhs of crores of uh, non-performing assets built over the last few years of UPA regime. I think had put pressure on the bottom line of many NBFCs and corporate focused banks. I think going forward, the credit costs will remain low. The provisioning levels are, one is clearly seeing, ICICI Bank results clearly bear them out. The pre-provisioning profits have started showing decent improvement, but more so it's evident on the net profit level because the provisioning levels are coming off very sharply. And that's why I think banking is one sector which optically will start showing very good YOY jump over the next few quarters. One will have to keep a watch on the emerging stress levels on the retail front because growth has been robust on the retail side of lending, and there have been some excesses, our channel checks suggest, in certain pockets of retail. One clearly has seen that in the MFI side, but there are other unsecured pockets of retail credit where there have been some excesses, which will come home to roost, as it always does in case of banking. It's easy to grow your balance sheet. As one of the leading bankers had jocularly told me that Ajay, this is the easiest business, especially if you're not the chairman after 2 years, and you don't have to be bothered about recovery. But jokes apart, I think one will have to keep a watch on the retail credit front, the trends, NPA trends out there. On the insurance side, having taken large hits, both in the first and more so in the second COVID wave, I think the commentary that's emerging from the life insurance companies is indicating moderation of claims because the hospitalization rates are low after the third wave. And the companies also, because of increase in reinsurance rates, are announcing progressively increase in product prices to alleviate margin pressures. The stocks haven't done too well, but I think if one were to look at a medium-term perspective, I think they do present good entry opportunities on correction. The financialization of the economy continues apace. So the AMCs should also sort of form part of the core portfolio. On the oil and gas side, I think the current quarter will show bumper trends because of the sharp rise in oil prices. The inventory gains will be strong. The GRMs on a quarter-on-quarter basis, if Reliance results are to be the barometer, will show improving trends. As long as the government doesn't interject insofar as pricing is concerned, which in my opinion they should not, the results for the current quarter for most of the oil refiners should be quite good. On the new age companies, I think we are at 11:03. So in next couple of minutes, I'll wrap up. Insofar as new age companies are concerned, suffices to say that I'm an old school person and I give a lot of importance to cash flow cash flows, free cash flows for many companies, when we are valuing a company. And during boom times, uh, I'll just take you back to 98 to 2000. I was new in the business, has started my career in SBI Mutual Fund in 95. And from 97, the TMT complex, technology, media, telecom, globally stocks in these three sectors started moving up. India followed suit. And many companies in these sectors did not have profits at that point in time. And then the investment bankers came up with this idea of valuing them on EBITDA, operating profits. But then they found that many of the companies don't have any EBITDA. So they said, let's value them on sales, price to sales. But then there were many companies that did not have any sales, any revenues. So then they said, let's value them on eyeballs. So you set up a website, you ensure that a large amount of traffic is engineered or will be charitable, I think, of its own volition. People look at what are the products you're offering on the website. And based on those eyeballs, the investment bankers on Wall Street started valuing the companies. And the times were such that investors bought into them. And then when the bubble burst, as it always does, in June 2001, the next many years were very painful for investors who had gotten into those companies. And even good companies which were in those sectors. I remember marquee companies like Infosys, which had real business, great Y2K opportunity, uh, stellar corporate governance. But in the frenzy between 97 to 2000, the price had gone up to, if I'm not wrong, 12,500. And by December 2002, it had come down to 2,500, if I'm not wrong. Similarly was the case with Wipro, from 10,000 to 800 or some such number. So when a confluence of FOMO, TINA, buy the dips, I think starts influencing investors, and especially callow investors who have never seen a bear market. And when the ball hits, as they say, the rubber hits the pitch, you start smelling the coffee. You realize that what matters is profits, and more than profits, cash flows. So when companies that have digital platforms that have come to market today, promising cash flows 5, 7, 10 years from now, and have been richly valued, I have my doubts whether they'll be able to weather the next 12 months without getting savagely impacted in terms of the stock prices. The derating that's going to follow is going to be savage. Already, I think 39 of the Nifty, of the NASDAQ 100 companies are down more than 35%. And some of the darlings of 2020-21, I think, have bitten the dust. The market has gotten narrower, even in America. And it is the top 10 companies, which essentially where people gravitate. So what happens is, when you reach an inflection point, the first companies that get impacted are the ones where there's been a lot of hype about non-linear growth coming from newer technologies, which understandably being newer, are not yet fully proven. In fact, I wrote an article, I think in June or May, on a company called Nikola in Economic Times, which had just IPO'd. and its market cap had exceeded that of Ford and of the owner of Fiat. And I had drawn the same parallels, what I had seen during 97 to 2000. And I think the MD of the company or the founder of the company has stepped down, is being prosecuted, essentially because he had hyped, I think, because the company had no production uh, of a single truck. They did not even have later on, I think they tied up with GM, and then GM went back on that agreement. But the point basically I'm making is that there are many such companies globally and in domestic markets. One will need to be very careful. So the first derating starts happening in these companies, and then panicked fund managers start gravitating towards uh, the large cap names, the familiar names. That's how the narrowing of the markets that's happening. In the global context, be it the FANGs, in the Indian context, some of the leading names, sort of, from Nifty. Because instinctively, a fund manager, and I've been for 25 years in various large organizations, you get judged on relative performance. And you would rather go wrong with everyone else. But if you take a proactive call and hold some cash, many fund houses don't allow you to hold cash, but if you were to take that call and to hold large amounts of cash, and if the market continues to canter, if not gallop, over the next, say, a quarter or so, that's a career risk that you face. So no fund manager would do that. So you want to continue to be part of the party, even when you know the punch bowl is being removed by the global central banks. Valuations are forbiddingly high. So I think we are reaching that point, I would say, where now people, like we saw what happened in case of Netflix in America, where the prices went down by 25% in one session. So even the larger among them, wherever vulnerabilities are seen, I think people start pulling out, and the derating starts happening. Coming to Nifty, I think the consensus expectation is of around, say 15.7 to 16% CAGR in earnings growth between FY22 to FY24. Roughly 800 rupees of earnings for March 23. So from that perspective, we are at around 21 times, 20 and a half times, 1 year forward, 1 year and 3 months. Let's take 1 year forward, which is at a significant premium to last 10 years average. We have seen massive outperformance on the Indian equities. The FIs have been net sellers, around 96,000 odd net basis in last calendar year, followed by around, I would say around 25,000. I don't have the exact number right now. In the after the buying that we saw in the first 2 weeks, I think the FIs on a selling mode. On the positive side, I think the SIP flows continue unabated. I think the Indian retail investors have provided a strong countervailing force to the FIs. But as I said, I think a sharp drawdown is when their metal will be tested. And so from this perspective, I would say that it will help if investors embrace some caution over the next couple of quarters. This is not the time to be adventurous in equities. This is the time to closely look at one's portfolio, identify the vulnerabilities, especially in case of companies which will be facing margin pressures and where valuations are rich. There's a little combination. Because the alternative assets are yielding such subscale returns, I think people have gravitated more and more towards equities. The real estate market, I think, is on the cusp of pickup. But I think I see consolidation in the uh, indices, some correction. I'm not foreseeing any crash because the general view prevailing in global uh, equity markets is that money will move towards fast growing emerging markets away from America for the next 12 months. And even in America, the shift from growth to value is clearly evident with the geopolitical tensions at their peak between China and its Western adversaries or trading partners. India is in a preeminent position to continue to attract capital, both on the FDI side and hopefully with India's inclusion in global bond indices. Massive amounts of flows could be seen for the first 24 months on the bond side, which will again lower down the cost of capital for many corporates. Uh, and on the equity side, selectively, wherever I think emergence of value is there, I think money would continue to move in. Uh, but we need to keep a watch on the biggest bugbear for Indian equities, which is crude prices. If crude continues to remain on boil, current account deficit, we are a country having large twin deficits, which today is not being focused so much by global investors. They'll start looking at and focusing more on the emerging macroeconomic vulnerabilities. And that again will sort of, in addition to the micro factors, as I said, imported inflation, margin pressures, slowing rural complex, all of this would then create a sense of panic, and one could see a sharp derating. So I think I've already taken an hour. I think I'll wrap up and we'll now throw the floor open for questions. Uh,
Ajay, now am I audible?
yes, sir, you're clearly audible, crystal clear.
Yeah. Immediate question. And this question I would like you to answer purely from the point of view of retail investor. Now, so far as the retail investor is concerned, say today, let's take TCS is at a particular valuation. Today, Zomato is at a particular valuation. I'm not able to visualize whether the price of TCS is correct or whether the price of Zomato is correct. And all people are talking about Zomato, Paytm, and all that. And in fact, SEBI is also holding a meeting as to what sort of restrictions we can put on price. All those are big players. How do I know as a retail investor whether the Paytm price is correct or not, whether TCS price is correct or not? That I am not able to judge. Price increases by money flow, liquidity, price increases by various other factors, different. But how am I to know that the price is reasonable? What's your take on this?
A simplistic answer would be to go back and don my hat as a fund manager of a mutual fund and advise all the little investors that it is better to invest in markets through mutual fund route. But that apart, I think insofar as these new age companies are concerned, the reason why there is so much of uh, uh, enthusiasm among investors is because of what's called a winner takes all effect. one has seen that globally and increasingly also in emerging markets like India, where a large opportunity size being chased by multiple players uh, through seemingly uh, unlimited amount of capital being poured by various VCs and private equity funds to develop the market, quote unquote, uh, leads finally to a situation where only one or two of them end up grabbing the large market share. And then the hope is that the consolidation thus happened will eventually lead to large pricing power with these survivors, and they'll be able to recoup those tens or hundreds of millions that they have blown in marketing, in creating distribution network, in creating salience of their brand. So you spoke about Zomato and Swiggy are the only two players in the sector that they're addressing. I mean, I'm talking about players with scale. And similar emergence one is seeing in the other large opportunities. If I go back to my uh, original uh, investment thesis, I look at stocks from three buckets perspective. The first bucket, as I call it, is the BVM matrix, the business fundamentals, the competitive intensity that the player is in, the margin profile, the growth, the opportunity size of the market, how vulnerable the player is from competition, uh, the cost structure, how it can squeeze out costs. And if after analyzing this, if I believe that it's a good business to own, then I think uh, that's one bucket cleared. But then I also have to wait after that with valuations. Hindustan Lever is a great business. Is it a great stock? Now, many little investors confuse the two. TCS, I'm not specifically talking about now one TCS, but TCS is a great business. But is it a great stock to buy today? And that's where a lot of people, they make a mistake. So I tend to look at what is the expected earnings growth over the medium term. So let's take next 2 years, because after 2 years, it's all crystal ball gazing. So when I read reports by a Goldman Sachs or anyone, sort of, any leading global investment bank talking about cash flows 10 years, 2040 and 2035, I think you should simply have a chuckle and just ignore that report, because no one uh, can actually crystal ball gaze beyond a few years. There are far too many factors, that will muddle the projections. So let's look at near term over the next 2 years. What's the earnings growth you're expecting for that company? And let's look at the trailing PE of that company. A simple matrix I look at what I called uh, price to equity, and compare that with the estimated earnings growth over next 2 years, and compare that with the trailing PE or PEG as they call it. And whenever I find that the market is valuing a stock, say I'm just giving an example randomly, at 60 times is the trailing PE, but the expected earnings growth over next 2 years is only 20%. I think the sentiment, the liquidity can ensure buoyancy in the stock price for some time. But when reality dawns, the vulnerabilities start emerging in these kind of stocks, where the market is attributing too high a valuation, in my opinion, for too low an earnings growth or projected earnings growth over the medium term. And this is happening precisely in many companies, even in great businesses. You value an FMCG company at 670 times trailing earnings, when the growth in earnings is only 15 to 18% at best over the next 2-3 years. the stock will do well, as I told you, because everyone is also, when a panic starts, moves out, goes into those stocks where there's a moat. But that moat doesn't remain as unbreachable, because finally it is the earnings growth that will determine the sustenance of that valuation. And when that is falling short, during tough times, it becomes most vulnerable. So I don't know whether I've answered your question directly, but what I mean to say is that even in case of be it TCS or be it Levers or be it Infosys or be it Asian Paints, I think we must keep a hawkish eye on what is the underlying earnings growth projections over next 2-3 years, because it could so happen that that great company, that great business, could give you a time correction. It might not fall in price. We saw the great Reliance doing nothing for 8 years, 2010 till 2017, if I'm not wrong. The Reliance price was flat because the company was investing tens of thousands of crores in building up new businesses, telecom and retail, which actually came on stream only towards 17, 16, 17, 18. And that's when the commercial operations for them started. People, markets being forward looking, start discounting it a year or so in advance. So I think that's insofar as traditional companies are concerned, the same doesn't apply to the new age digital platforms, because then there are no earnings that you compare them with. Now here, as I said, I think the market positioning in terms of uh, how consolidated the market is, whether there are only one or two players, how strong the market's position, and whether the company has the pricing power, maybe if not immediately, a few years from now, is something that will determine whether the sustenance will be there. But as I said, I think the uh, the torrent of liquidity, the gush of liquidity has been so strong in these new age names that it is understandable that many of them will come back to the ground insofar as valuations are concerned. So they'll move from that phase of extreme exuberance to complete despondency. That phase we have not yet seen. From 161, I think it's come down to 113, if I'm not wrong. Zomato. Now, I don't know, but it's at a significant premium to its issue price. So I am not saying it's reached that level of despondency. So the exuberance one saw. Now wait for despondency before you jump in to buy these new age companies. Because in asset markets, I think the point of entry is something which is the margin of safety that you have when you enter a stock or a real estate or any such asset. I think is something which is most crucial. We haven't yet reached that point for me to plunge and start buying these new age digital platforms because of a minor correction that one has seen over the last few days.
Dhruv, you can ask other. Thank you, Ajay. I will ask some other questions later on, but let other questions come first. Dhruv?
Yes, sir. Yes, sir. Thank you very much. You did not specifically speak on the interest rates, while you did mention about the trend which is now emerging from the central banks of the world, and how RBI is also, now required to take an action just to contain inflation. Uh, Now there is a conflicting, issue over here. Well, interest rates have been kept low for a specific reason by the RBI. With the changing scenario today, RBI may be forced to increase the rates. You said capex cycle has not really taken off, and that would actually push the earnings higher. So, and then we are looking at a multi-year, uh, 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 you know, business taking off in India. So how does this all fit together with the interest rate being at the center?
Uh, Structural sustenance of moderately high earnings growth in any economy can only happen if there is no malallocation of capital and if the interests of both investors and savers are properly balanced. In the wake of both the global financial crisis and more so the current pandemic, the intent of the policymakers was noble. It is to ensure that businesses continue to survive and then thrive with lower cost of capital, and consumers continue to consume through direct infusion of grants, you could say. However, there is a uh, massive body of academic work that has now shown that a significant chunk of this liquidity that was created has found its way away from real economy into financial economy. As Rajwade Saab, the great forex expert Ananta Vishnu Rajwade used to say, the tail has started wagging the dog. The financial economy today has become 4 times as large as real economy. And as per Uchir Sharma, the financial economy was the same size as the real economy till, I would say, 70s. So this financialization of various economies, especially in the Western world led by America, there have been many benefits. At the same time, it also has had an impact of amplifying the uh, cycles, both on the upside and on the downside. Unbridled speculation is something which is also part and parcel of this perversity, I would say. And both Alan Greenspan, followed by Bernanke, uh, were loth in ensuring that they could see the asset price bubble building in front of their eyes. They either were ignoring it or sort of, they were not proactively trying to restrain. If inflation in the real world deviates from the targets, there is so much of hula bullo. Our target is 4%, it is running at 6%, America is 2, running at 7. Because inflation hits the most vulnerable sections of society. It is a tax on the most vulnerable section of society. Pensioners, savers, and people in lower income strata. You'll be surprised to know 1% of Americans own 40% of total wealth in America. And 50% of the Americans in the lower end, they own less than 1% of wealth. And top 10% of Americans own nearly 70 to 75% of total wealth. This inequality in wealth and income streams is what has led to social discord and massive, it's manifesting itself in terms of hardening attitude against immigration, against global trade, against globalization in particular in Western world. And that's why the emergence of what's called right-wing politics in West and in many emerging countries. So somewhere, I think the unbridled financialization uh, encouraged by policymakers in the West and increasingly now in emerging markets is at the root cause of this growing inequality and social discord. And now I think there's a blowback that's happening, which they better take note at their own peril. Coming to an interest rate question, I think how you calibrate the rise is important. A sharp jump happening over a short time period of time is something which can really act as a headwind. But if you ensure that the rise in interest rates is calibrated in a manner which doesn't destabilize the financial system, I think that can act as, I would say that will not act as a headwind. And let's face it, I think one of the signature reforms of the current government was ensuring that the inflationary expectations are well anchored before the pandemic at 4%. They have deviated because circumstances demanded, and globally everyone has done it. But now it's time to put the genie back into the bottle, or else I think that will have an impact on the investment climate. It will also have an impact on foreign flows if you allow it to remain to continue to rise unabated. And there'll also be political blowback. One is seeing now there are elections in key states, and price rise is something which the opposition will try to uh, use as a tool. The government will try to counter that by saying that we are offering free rations. Uh, so I think this is a dynamic that's playing out in many economies. Uh, I think interest rates have bottomed out. The pressure on the RBI is increasing by the day. And they will not be able to, in my opinion, resist for too long. They have been using the pretext of now Omicron variant, but the economic activities haven't really been curtailed in by many state governments uh, because of the blowback from the citizenry. And hence, I think, unlike the second wave, one clearly is seeing the fast indicators of movement not to have gotten impacted. So I think already there is a dissent in the NPC with one member asking for a quicker rollback of the monetary accommodation and raising of rates. So I think we'll start seeing the first move being made on the reverse repo side. The corridor will be narrowed. And then I think the repo rate also should go up within the next quarter or two, I think. The earlier they do it, the better. Because I think you need to ensure that uh, there is sort of, uh, uh, the, the inflation in the asset prices, I think also needs sort of to be kept a close watch, in my opinion, by the central banks. They are not doing a great job of that.
Thank you. You mentioned calibration of how the increase is happening. That's very important. Uh, I'll just take a couple of questions from the participants. One question is coming here. Many software companies are going for share buyback rather than giving dividends. What does this have on what impact does it have on the valuation?
Uh, it's a very good question. I'll tell you. Uh, see, uh, keeping cynicism aside, a buyback is a more tax efficient method to return excess cash to shareholders. That's the basic principle. So a dividend is more tax inefficient. So from that perspective, it's good uh, if companies try to return the excess cash, and the IT companies are generating massive amounts of cash, free cash flow, I'm saying, is after the capital requirements, capex requirements. So it's a very good trend that more and more companies are going in for share buybacks. Now, again, the uh, for the last 20 years, more so, the methodology adopted by many companies to remunerate their top brass, and increasingly also the middle management, but more so the top brass, is by having not so high fixed compensation, moderately high variable pay in terms of bonus, but a large amount of compensation is paid to them through ESOPs. The logic used is you would like to align the interests of shareholders with the management. So if the share price does well, someone like me who owns 100 shares in a company does well, and a large institution does well, and then the management that actually drives the business and which has a large part of its compensation in terms of ESOPs also does well. So it's all win win win. But is it? I'll tell you the reason. It has been found that this also leads to the perversity of short termism. What do I mean by that? Is many CEOs, academic studies have shown in America, there are exceptions, but many of them have short tenures, a few years at the helm. And hence, what that forces them, compels them to do is to ensure that you end up taking decisions which are more tactical rather than strategic in terms of cutting costs, in terms of not investing enough in distribution network, brand building, expanding in new markets. So wherever the ROI in the short term is not very high, although in the long term that would compensate, but then you're not at the helm after 2, 3 years. So this excessive focus on the next quarter, the next half year, the next year or so, in which you want the share prices to remain buoyant because your compensation majorly is linked to the ESOPs, the share price. And then, so this is the dynamic which is making a lot of policymakers uncomfortable, especially in the US. So to answer your question, a share buyback essentially means you are reducing the supply from the market. If you have 100 shares, you buy back 10 shares, now there are only 90 shares. The denominator goes down. So for the same earnings, your EPS goes up. And a rising EPS means if you apply the same multiple of valuation, the share prices will, everything else being the same, should go up. But as I said, if I am a pension fund who is holding a stock for 20 years, and I'm not going to buy and sell, say every 6 months or 1 year, that short-term pop, when the management exercises the ESOPs, the MD changes, and then the questions about not enough investments in newer markets, newer products, newer geographies, cutting of costs unwarranted from the long-term perspective, comes back to the share price craters. I'm not saying TCS is doing it, but I'm just giving you a broader perspective of this whole share buyback, the positives and the negatives. Hope I've answered it.
Thank you very much. We'll take one more question. So this rise in market and the indices reaching 60,000 in case of Sensex and Nifty around 18,000. Do you think, is it the new investors who have entered in equity? Are they the one who have pushed these prices high? This is despite the kind of things that we are hearing about, that the inflations are going up and liquidity will be pulled out at some point in time, and the prices continue to rise. So are these new investors who are pushing the prices?
I mean, I would not lay the blame entirely on new investors. I think fund managers represent not only old investors, but also fund managers in mutual fund and insurance companies represent not only new investors, but also old investors. And I think I elaborated in detail about no one wants sort of, everyone wants to be in the race because no one wants to stand out. Because if you underperform for 2 quarters as a mutual fund distributor, you can very well vouch the kind of fire that underperforming fund manager will have to face. Although, if the market were to crash, he will be hailed as a genius, but that will be sort of only after the event happens, and none of us can predict with certainty when that point of inflection comes. I think, no doubt, new investors globally and in India have been a force to reckon with. Clearly evident from the number of demat accounts that have opened, or if you look at the market ownership by the retail investors, it's moved up quite sharply over the last 2-3 years. And many of them, as I said, are young, from generation Z. They haven't yet seen a sharp drawdown in their assets. But I would not blame them alone. As I said, a confluence of circumstances, and the root cause is this massive liquidity generated by global central banks and supplemented by the fiscal authorities, which basically has created conditions where the risk taking has been encouraged to such an extent, and with alternate asset classes yielding post-tax paltry returns. So confluence of this has led to the massive buildup of asset price bubbles. I was reading a very interesting article. I'll share that with both Mr. Patil, with you and Dere sir, by Jeremy Grantham, one of the leading global investment managers of GMO. It's a powerhouse globally, where he basically hypothesizes that till January 21, the American markets were 2 sigma away from the last many years of averages. Today, they are 3 sigma away. What I mean by that is that the craziness in terms of valuations, this 3 sigma event happens, according to him, once in decades. And the last time it had happened, according to him, was, I think, before the global financial crisis. But what is unnerving is, at that point in time, the other asset classes were not as richly valued. Today, there are simultaneous bubbles in American housing market, in American equities, American bonds, because the interest rates have never been this low. So obviously the bond prices are so high. So there's a bubble even out there. As interest rates rise, there'll be a massive erosion in the price of the bond holdings that many of the institutions and investors hold. And there's also a mini bubble in commodities. So we have 3.5 bubbles in equities, in housing market in America, in bond markets in America, and the half one he's attributing it to the commodities. So we are in for, in my opinion, a rough ride, because it's a global village. If there is panic in the developed markets, we can't remain immune. And as I said, I think a time certainly has come where we need to look at equities not simply through the lens of the 3 acronyms that I told you: FOMO, TINA, and BTD.
Well, Dhruva, I think there is no time left for other
Yes, sir.
questions, although
Yeah.
you must be having those questions. On behalf of Lokmanya Seva Sangha and on our behalf, let's express a very hearty vote of thanks to Ajay for his excellent and studied and candid presentation of the economy as well as the investment climate. So, Ajay, we are all happy that you came and you answered all our questions. Some of the questions are still unanswered, but we shall raise them some other time. Now I request Dhruva to start our closing pasayatan. We shall close the session.
Right, sir. Thank you very much.
आता